So today on the show, I'm very excited to welcome back Ryan Watson from Upsourced Accounting. Ryan, I want to say we last talked a couple of years ago, so it's been a while.
I
But
think that's right.
yeah, and it's always good to get people on to refresh on the story that the numbers are telling. So
Yeah.
it's always fun to have you on as well as like your I don't know, friendly competitors, contemporaries, colleagues. Marcel's
Yeah.
had a
Rising
positive
tides,
role. Yeah,
So, yeah.
exactly. So I think, my first question is just like, how would you describe what you're seeing out there over the last, let's call it 6, 12 months or so?
Yeah, totally. Yeah, and just to frame, obviously, we're at Upsource. We provide outsourced accounting and CFO advisory for clients, right? So we're sitting in the finance chair for our clients, and to answer your question, it's been really interesting. And by the way, we get this question all the time. I mean, I think definitely like a lot of folks are trying to figure out like what to expect because it has been turbulent. If you zoom even a little bit further out in the agency landscape, which is the industry we exclusively service, the industry landscape had some of its best years on the other side of COVID because of the PPP funding. And then we sort of ran, 90 miles an hour into a brick wall that was 2023. And 2023 was a particularly difficult year. And 2024 was, for many of our clients, not a ton better necessarily.
Yeah.
And so again, you've got a lot of folks trying to figure out like what should I expect? And I think the best way for me to describe and we've got about 119. I say about, that's a very precise number. We have 119 clients that we service. And so the best way for me to try to like summarize the situation is to say that I believe on average, 24 was a better year than 23 for sure. And the tailwinds in the first quarter look very positive on average. But I will say that the year of 2024, and we're involved in this network, the Nostos network. I don't know if you're familiar with it, Dan, but it's a community of slightly larger agencies. And they put out a survey that we were just looking at, and it said basically the same thing. So we're speaking the same language, which is the 2024 is kind of a tale of two halves, right? So like on average, pretty, like an okay year, but to be honest, not uniformly distributed. So you had one half of agencies that were experiencing some of the best growth that they've seen in recent memory, and others that were sort of actively going out of business or struggling. And similarly in Q1, I'd say on average, where folks are feeling more optimistic than less optimistic, but that's not everybody. And that's definitely true for us too. Um, and it's a little bit hard so that's kind of it. Like on average, I feel very positive about the direction, the direction that the industry is going, with the exception of, again, not uniformly distributed. There's plenty of folks that are still feeling, a little bit like I'm not really sure what's next. Some of that's industry specific, some of that's size specific. Certainly the clients of ours that had a lower critical mass and were a little bit newer slash less established are struggling to win new business. I mean, I think that was definitely, this is the last thing I'll say, and then feel free to ask follow-ups. It was definitely true that the clients that had good, strong years in 2024 did so on the back of existing relationships rather than on the back of new relationships. You could win new business, but sales cycles were longer and close rates were down, in large part because it's just what happens in an election year. There's a lot of uncertainty that leads up into a potential new administration, and so you just found a lot of buying departments were reticent to make firm decisions. But existing customers that had existing budgets, we did see folks expand those, and clients who could lean on those had success, and clients that didn't had some really had some really tough years. So anyway, we see things getting better. Though the last thing I'll say is there's a lot of uncertainty going on right now, just with what's happening, especially on like the federal side and federal budgets, that is creating a little bit more uncertainty and maybe just a bit of pause on some decision making as well. So
Yeah,
anyway, it's
it's
weird, it's choppy.
right, and it's interesting because sometimes I'll get questions like that, like where do you think things are going, and there's this that going on in the macro. How should that affect us? And I always find those to be tough because it's hard to ex post facto figure out like, well, did this bump or dip in business happen because of the election year, or something else. And I'm always more
Yeah.
inclined to say it's probably because you weren't prospecting 90 days ago. That's probably the
That's right.
most
That's right.
direct
Yeah.
effect. But that said, I'd love to hear your perspective on this. Like, is there anything that maybe you're seeing in the numbers that you can use to differentiate the micro or the macro, if that question makes sense?
The extent to which your troubles are a function of your execution or a function of the macroeconomic environment.
Correct. Yeah.
Well, I would say I don't know if it's as look, I'll say that a lot of the agencies we work with are 4, 5, 6 million in annual revenue, and while all of those have sort of revenue generation functions and are using CRMs and things like that, probably don't have like the fidelity of data to be able to really pinpoint like I sent this many emails, I made this many sales calls, and my win rate went from 32 to 42 or whatever. But I can say a little bit more subjectively, a little more anecdotally, it is definitely true on average that the clients of ours that have good, strong, established, again, revenue generation functions, and just generally speaking, have strong positioning and execute well, they had good years. And the ones that struggled are the agencies that had historically relied on word of mouth, organic, referral based sources of revenue, and didn't have more repeatable approach to generating revenue, found that some of those less repeatable sources dried up. And so, the very blunt way to say is like, and this is not true. We have some clients that have very strong businesses with strong positioning and really solid sales groups that have struggled. But on average, our clients with better businesses did better than our clients with worse businesses. I mean, that is true. It
Yeah.
was a tough environment. Like, it's worth saying because in 2021 and 2022, you did not have to execute particularly well to have a strong year. In 23, 24, you had to execute well to have a strong year. And those that did not execute well did not have a strong year.
Right. I've seen a lot of that too. There was kind of that crazy money floating around era that happened post
Yeah.
COVID. Yeah.
But I do think there was enough. I mean, but to answer your question, like, I think there was enough. I think there was enough. There were especially related to the elongated sales cycles. There was enough to say there was more than only a lack of execution. I believe there was clearly something macroeconomic happening
Yeah.
last year. I
Yeah.
do not believe that it was exclusively macroeconomic. And certainly we had clients that succeeded despite macroeconomic conditions. But were there headwinds? Yes, I do believe so.
Yeah. Makes sense. One thing you mentioned is that, naturally the clients that with strong positioning have done better. Can you talk about that a little bit more? Like, how do you define or how do you see strong positioning in your business?
Well, I mean, I'll be honest, like, compared to somebody like you who is in the sales sort of arena all day, every day, like what I'm referring to is so much probably more basic than what you see, which is, look, we still have plenty of clients that like, or prospects, or we see plenty of folks that have, almost no position. Like, hey, we do branding for like middle market businesses, like period, right? Like you're in our town and you make $10 million a year, and you're a brewery, or you're a sandwich shop, or you're whatever. Like you're our client. Like you need a $50,000 identity package. We're your people. Like that's just a really tough business for a bunch of reasons. One, again, there's no right to win. There's no reason to believe. There's no there's no repeatability to that revenue stream. And so those have, really struggled, right? Versus the agencies that have domain expertise and a strong point of view, right? Like not just we do, e-commerce retention marketing, but like we believe that the best way to succeed in this space is X, and that's what we do. The folks that have like a point of view in their space are the ones that we see succeed more than others. Does that make sense? Does that answer your question, Dan?
It does, yeah, and I think
Yeah.
that's similar to what we see, and it's back towards the probably like the biggest topic we float around, which is specialization and figuring out what
Yeah.
that looks like.
Yeah.
And I don't want to put you on the spot too much, but I'd be curious
Do
to
it.
understand like what's your point of view look like when it comes to agency accounting? Are there things that, yeah, what do you think is underrated versus overrated to focus
Yeah.
on? That
Yeah.
kind of thing? Yeah,
Well, that's it's funny. I like this is so top of mind because it's so funny. A colleague of ours in like the agency space, Tim Thompson. I don't know if you're familiar with Tim. He's in RevThink, but he posted something on LinkedIn. I don't even think it was his. I think he like reposted it. But I've been thinking about it all day, which is
yeah,
like this whole kind of like slideshow on the idea that like niching isn't enough, right? Like we've all done that now. Like we've all decided that we have a specialization and we've niched and now that we've all done it, it's no longer a point of differentiation. And the
yeah,
next frontier is not just having a specialty, but having distinct point of view within your
right.
specialty, right? This is how everyone does it here, and we do it here differently. Anyway, I've been thinking about that all day. To answer your question about how we think about accounting
Yeah,
and finance differently, we do have a point of view, and I think I think our point of view is, I think one of our biggest differentiators in the way that we think about finance for an agency is that a lot of entrepreneurs and then a lot of just like, finance functions or whatever we approach finance as sort of like a monolith, right? Like, here's my KPI dashboard. Here's the 10 metrics that we should monitor to determine do we have a healthy or do we have an unhealthy organization, and let's look at those together and let's like dial in on the ones that aren't doing well and celebrate the ones that are doing well. And we as an organization do not think that that's a very healthy or productive way to manage your organization. What I believe is that based on where you are as an agency in your agency life cycle, right, in terms of like your maturity, as well as what you're struggling with, there's probably just one or maybe two things that truly matter, that would truly move the needle for you in that moment. And everything else is just noise. And so I think that for a couple reasons, one of which is like if I think about the various KPIs I could measure for an agency, they're not mutually exclusive. They're not all these like dependent things that are unrelated to one another. They're all mostly related, as in when I improve one metric, I'm downstream improving a variety of other metrics, right? Like if I improve my gross margin, surprise, I also improve my net margin. And so, and if I improve utilization, I improve gross margin, which improves net margin. So like they're all kind of related to one another. And so when one of them is bad, many of them are bad. And so psychologically speaking, it doesn't do a founder any good to look at a dashboard of like red screaming KPIs that just make me think like, oh my God, this whole business is going under. What do I even do? Right? Like, okay, well, that doesn't help anybody. And the reality is like, well, I can't attack everything at once. So why don't I attack the highest priority, highest leverage problem, solve that problem, and then raise my head up and see where should I focus next? And so for that reason, we've said looking at your sort of like basket of KPIs in totality as a way of managing the finance of the business, wrong answer. The right way to do this is what we've created as the hierarchy of financial needs. And what we've done is we've taken like the basic KPIs for an organization and we've ordered them in a sequential hierarchy, similar to Maslow's hierarchy of needs.
Yeah.
And so we've basically said like, in the same way I can't worry about self-actualization if I don't have shelter, I can't worry about repeatable revenue generation if I can't make payroll next week, right? Like I have to triage this one very specific problem before I can even bother with some of these like medium and longer term problems. So the hierarchy of financial needs is the way that we take an agency and we evaluate where are you, like what are your challenges and what is the one thing we should focus on in this moment before we have the privilege or the permission to move up the ladder to the next thing. So
Yeah.
that would be one area where we feel like the world is kind of approaching this problem the wrong way. And let's apply focus and prioritization to helping you create some progress and momentum. Even if the agency is maybe not in a great spot, we can still give you some quick wins and get the train rolling.
There's so much you're talking about. I was just like smiling the whole time because it's a great way to think about this. The first thing is it reminds me of this book called Obliquity that I read a few
I don't
years
think I've
ago.
read it. Okay.
But basically, they talk about how like there's a bunch of great examples, but there's one that they pull out from some Fortune 500 company. It might have been in the manufacturing space, and they had
Okay.
gone through like this whole slew of CEOs, and the share price was doing horribly, and they had all these CEOs that would go promise the world and restructure the
Yeah.
organization. It all fell apart, and then they had one guy that was had this like very just taciturn speech to the shareholders, and he's like, I'm only going to focus on one thing, that's worker safety. And then he like walked off the stage, everybody dumped stock, but he ended up like only focusing on worker safety, and as a result it like improved absolutely everything else
All
because
these other
people
things
had to
downstream.
communicate better. Exactly.
Yeah.
So that came to
That's
mind.
interesting.
I
Yeah.
also I also love the Maslow's frame because, and I think this is bigger than just controllership or accounting.
Yeah.
So much business advice is not specific to like where you are. And like one of the worst things you can do is applying like the right advice at the wrong time. Where it's like I think all
Totally.
advice should be like you should get like a compass with it, or like that map at the mall that says you are here. Like you should
Yeah.
start, there should be that frame attached to everything.
I,
And it's not even just revenue based. It doesn't have to be based on numbers. It
no.
can be based on anything, what you want to achieve, size of team, whatever it is. But with that, I don't want to shortchange the audience. Can you go through that
Oh
hierarchy?
yeah, yeah, yeah. Sorry, sure,
Yeah.
sure, sure. Yeah, so yeah, I'll go. I'll kind of go somewhat quickly, and then we can swing back and talk about anything. But at the bottom of the pyramid is solvency, right? So it's basically just like, am I solvent? Can I make payroll next week? Do I have like, can I keep operating? And if the answer is no, which and I say this not in a derogatory way, but mostly if you find yourself in this bottom, you should know that you're not alone. Like a very non-insignificant percentage of the agencies that we meet find themselves in solvency crisis and are operating in a sort of payroll to payroll kind of a situation. And if that's the case, then we absolutely have to figure out like how, I mean, again, we have to figure out how do we get access to cash in a way that does not increase our personal debt, but is coming from customers or in some cases, maybe personal wealth or whatever. But we've got to find a way to like keep the doors open for long enough for us to find a way to make this agency profitable. So that's the base. Like, we can't do anything if we can't keep the doors on for another, 2 to 4 weeks. Solvency. Once we've done that, then we move to the next stage, which is gross margin. And gross margin is, in large part where this is kind of the whole ball game of an agency. So gross margin, by the way, is revenue less cost of goods sold, or in other words, like the cost to service the revenue I've sold in an agency. It's mostly service salaries, but it could also be other, project costs. Gross margin is that reflected as a percentage, right? And so in most agencies, we're targeting somewhere in the neighborhood of 50%, maybe a little more, maybe a little less, depending on the type of agency. But look, like if you can earn a solid gross margin as an agency, you absolutely can earn it can become a profitable like net profit agency. And if you don't earn a good gross margin, like it doesn't really matter what you do with regard to all other like budgeting and overhead kind of costs. This is it. Like this is the unit economics of an agency. So gross margin is the second step. By the way, the levers of gross margin are project profits and utilization. So if we are at gross margin, right, and we're saying, okay, we have a gross margin problem, like the unit economics of my agency are not working, it's because we either have one or both of a utilization problem. In other words, like we have a bunch of people on staff we're paying to service the projects, but we don't have enough projects for them. So we're just spending wages on stuff that's not earning us any money. That could be a problem. Or it's a project margin problem. In other words, like, no, we have the projects. It's just we're not earning enough on these projects on a per hour basis to sort of generate a good gross margin. Those are kind of the two inputs. And so that's step two. Very, very, very fundamental to the agency. Once we've cleared, and by the way, you never really permanently clear gross margin. That's the thing that you're kind of always optimizing for. But once we've figured out how we have machinery to help us optimize the gross margin, then we're in cash reserves. So that's like, can we generate enough? Can we accumulate enough cash? In our case, usually 3 months of fixed monthly operating expenses in order to sustain us through the sort of highs and lows endemic to what is largely project-based cash flow. Agencies famously, receive cash in big chunks And there are a lot of project-based revenue out there. And so you need cash reserves so that you're not back in a solvency crisis. Fourth is net operating profit, right? So now this is like, am I profitable after paying for overhead and owner salary and all that kind of stuff? Am I actually making money, yes or no? And again, if you have a good gross margin, you definitely can make money. And if you don't, you won't. And so we normally target 20% of profit, net operating profit. And then the fifth and final, the capstone to the hierarchy of financial needs, is repeatable revenue generation, right? Do I have a mechanism, a set of consistent activities that generate a set of somewhat predictable results that generate revenue for me beyond the incidental word of mouth, organic referral, whatever the things, and so that is kind of the capstone in the hierarchy of financial needs.
Yeah, that makes a lot of sense, and that is pretty useful and concise, which is always
Yeah,
good.
yeah, yeah.
Yeah, I think to dig into that a little bit more. So let's say, like, I guess let me back up. What is the most
Yeah.
common situation? Like, where are people usually coming in when you're working with a new agency?
Well, so almost, I mean, again, occasionally we have just a solvency crisis. It's like whatever, but more commonly, I'd say 65% of the new clients that we work with have a gross margin opportunity. I'll say that's my optimistic way of saying
Yeah,
problem. They have a gross margin opportunity,
right.
and again, generally speaking, we're going to want them in the 45 to 55% range, with a few exceptions of different business models, and they are not there. And again, the two most common reasons are one, of course, it's a utilization problem, but the sort of story behind the utilization problem is not like that they don't realize they have a utilization problem. It's one of persistent optimism. So entrepreneurs are optimistic people by their very nature. We have to be, right? Because if we weren't optimists, we would not own a business, right? Like the median outcome of an entrepreneur is maybe not necessarily better, all costs considered, than the median outcome of an employee. But the top third or quartile of outcomes is way better than the top, than the median outcome of an employee. So the reason we all start businesses is because we think we can be in that top quartile, right? And this is the reason that we do it. So we're optimists. But the problem with our optimism is sometimes it sort of trickles into our decision making. And so we know we have too many people at the agency, and therefore we know we're not earning enough money. But we just got off that really awesome sales call with a potential $250,000 project, and I couldn't possibly reduce my staff today because who's going to service this incredible project I just learned about? When in reality, like, and there's always one of those, right? So, fast forward 4 weeks, that opportunity dissolves, but I just had another sales call and it was really awesome, right? Versus the kind of founders or the kind of entrepreneurs who are using data to make these decisions about whether they have enough, too many, or too few employees, and are using their weighted pipeline in an objective way to determine their weighted expected utilization. And so the folks who come to us with gross margin problems that are because they have too many people are not using data to say how many people do I, on a booked contractual basis, how many people do I need to service this revenue? And if I were to add in the weighted pipeline, how many people do I need? And do I have too many? And generally speaking, in those cases, the answer is yes, I have too many, and I'm being too optimistic about the future. And unfortunately, I need to let some air out of the tires, and that air looks like some rolls. So that's like very common. And then number two, of course, is like I have projects that I intuitively know are tanking my margin, but I don't have a mechanism to measure project profit on a consistent enough basis for me to be able to know exactly by how much and who, to be able to have the feedback loop to say, okay, well, why? What is happening? Is it a scoping problem? Is it a communication problem between the salesperson and the delivery people? Is it just is it just the delivery teams are just blowing scope and we're not pushing back? Like there's all sorts of little idiosyncratic reasons. And if you don't have like a good feedback loop, a mechanism to measure and ask and refine what's happening at the individual project level, then it's whack-a-mole. It's impossible to solve that problem. So those are the two most common reasons why we're not earning a gross margin and we're not making any money.
Yeah, that makes sense. I kind of want to dig into the first one, I think, which is,
Yeah.
and to take a step back, we have clients that are doing outreach and biz dev prospecting, et cetera, and they have a lot of hand wringing over how to specialize, who they should be focusing on, what services they should focus on, what size of the company. We've had
Yep.
this success over here, this success over there, and it creates like a lot of indecision. And so
Yeah.
I'd love to hear like how much are you guys brought into the rooms of those sort of conversations, and how much do you see agencies kind of looking at their best, most profitable services to decide everything else as kind of the starting point, if that makes sense?
That's a good question. I mean, to answer the first one, we are often brought into those conversations. I mean, for better, like, because those conversations start from the place of I don't have enough revenue, right? Like I'm losing money or I'm running out of cash or whatever. And my solution to that problem is I don't have enough revenue. And so in order to solve my financial problem, I need a revenue based solution, in some cases anyway. And so then it's like, okay, well, what should my revenue based solution be? As far as how often the answers to those questions are data driven and like, well, let's just kind of evaluate what's working. It's all over the map, to be honest with you. Yeah, it's all over the map. I mean, sometimes yes, sometimes. I mean, part of the challenge, like even in your anecdote, sometimes it's like, again, we're going from gut feel. We have this like one thing that's working, and it's hard to know like how well can I extrapolate that? Like, what's really working about that client? Is it their industry or is it the relationship I had, or you know what I mean? Like it's hard to really know what do I glean from that
Let me
success.
try to phrase it a little bit better because I think I was kind of clunky with it. I think so.
Yeah.
It seems like with your process, you could help an agency figure out, okay, this thing that we have, like if it was a manufacturer, like we
Yeah.
make this hammer and this hammer is
Yeah.
really good. So let's just go out and sell that hammer, right?
Yeah. Yeah. Yeah.
Um,
Yes.
so
Yes.
I'd love to hear like, yeah, is
Yeah.
that
I
what
see what
you're
you're
going
saying.
with, and how does that pan out? So it's like,
Well, I mean, yeah. And again, every agency is different, right? So sometimes you sell a homogenous offering, you know what I mean? Like I'm doing SEO or I'm doing social media buying or even just organic social media management, and I'm predominantly doing the same thing for the same kind of clients. And the reasons my projects are going well or not going well are very idiosyncratic. Like this client's situation is working and this client's situation is not working, and we just have to solve the idiosyncratic. But other times, for sure, you find that this, like the classic thing that you find in some situations is like, hey, the clients that are spending the least amount of money with us are demanding the most amount of our energy and our attention. And you start to peel back the onion on why is that, right? And sometimes the reason is because, well, those clients that are spending the least amount of money with you are the smallest, and for them, that budget is the most meaningful, right? They don't fully appreciate the value you're providing, and they weren't, and so they weren't fully kind of. This was a big stretch for them to be able to afford you, and so now they're like really focused on making sure that they get every ounce of value from it. Whereas the clients who are spending more with you are often larger and more sophisticated. They understand your value. The budget does not represent such a meaningful chunk of their available spend, and they're just much easier to work with, right? That's like a classic insight that's so replicable from agency to agency and industry to industry. And you learn things like that, right? Like, oh, okay, this kind of project is working. This kind of project is not working. And what is it, right? Is it the nature of, occasionally it's the we have agencies who have high cost rates. Like they specialize in hiring really smart, flexible people, and they sell a combination of executional work and thought leadership kind of work, like advisory and execution. And so we might find agencies like that are really struggling to make money in execution oriented work because their cost rates are just too high, and they have not figured out how to to staff those kinds of projects. And so we have to make a decision. Either we need to rethink how we execute on these projects, or we just need to say we are well suited to the high dollar, high cost rate advisory bespoke work, and this execution, like, we're going to do strategy, but we're not going to, like, traffic media campaigns, as a for instance. So it's agency to agency, but absolutely, like, that's kind of what you hope to be able to glean when you go through the project profit exercise. You have to go brick by brick. You have to look at project by project and treat every project like a unique snowflake and just solve that project's. If this project is earning a 30% margin and our target is 65, we got to figure out how to turn that project around. But what you are hoping you find is that my 3 projects that are the lowest have something in common with one another. And my solution is now not idiosyncratic, but actually I can apply broadly across the organization in either positioning or process or whatever else. And so that happens for sure.
Yeah, and it's funny because when I've gone through probably a less sophisticated version of what you're talking about, or talked to clients that have, it's often that there aren't surprises, right? Like the working with small companies and that are annoying.
Yeah.
It turns out they're not profitable. So
It's not worth it. Yeah.
big surprise
Yeah.
right there. That said, are there any, like, if you have examples, that would be great. But are there any situations where that you can recall where people are surprised, like where they look at the numbers and they're like, turns out this thing was way more
Yeah.
profitable, way less profitable than I thought.
Well, I mean, I can think of one client where the counter example to what we just described ended up being true, where this was a client that was they had monthly recurring revenue, and they were providing a homogeneous service. They were actively trying to move themselves up market to more sophisticated, higher dollar contracts and away from some of the lower dollar, less sophisticated contracts. And so, again, the conventional wisdom is the clients who pay the least are the ones that are the hardest to work with. However, this particular client found the exact and also just kind of had a natural bias against its small dollar contracts and its less sophisticated clients because, it had a strategic priority and it was to move up market. But when you did the analysis, you realized that the margins they were making on these small dollar offerings were like 80%. And the margins they were making on these higher dollar clients were sub 40%. And which was not, again, like that was not at all what they thought, or even what I would have thought, to be honest with you. Because again, like that sort of violates the conventional wisdom. And I think in their case, it was more of a temporary problem than a permanent problem. Like, I think all that data suggested was, well, look, you've been doing this for a long time, these smaller dollar clients. You figured it out. Like, they're on autopilot. It's working, right? And so these new things, you don't know how to scope yet. And you have sort of systematically scoped them all under. And you are, like, the thing that in that classic sort of evolution, the thing that you underappreciate is there is a higher, like, as the dollar of your contract grows, the standard deviation of outcomes also grows. And so they're just more volatile. There's just a little bit more risk there. And when you haven't done it as much, you have a higher risk of getting it wrong. And so, again, I think what they ultimately took from that was, well, these smaller dollar clients do a couple of good things for us. A, they're actually pretty reliable sources of, like, consistent margin. B, there's a higher volume of them, and they kind of de-risk this other sort of like concentration risk that I'm creating over here. And they actually kind of like offset some of the risk I'm creating. So I'm going to maybe slow down on my urgency to try to rid our business, to kind of leave them in the past. Maybe we'll sort of continue to service that as a part of our business going forward. And then just kind of realize that, like, well, now that I'm approaching a different kind of a client with a different set of needs, like, how my approach to pricing those and mitigating my risk of being wrong when I price them has got to be different. Like, I'm selling a different kind of product now. So anyway, that was just like an example where it was definitely a counterintuitive result, especially relative to the example we had just said.
Yeah.
And that stuff happens all the time.
Yeah, that makes sense that could happen. I think that's something you see probably especially like software businesses because they're when they're serving bigger companies, there's just all these things those bigger companies expect versus just small companies using software as intended. So that makes
Yeah, yeah,
sense.
yeah.
Um,
Yep.
to shift gears a little bit, one thing that has always come up, but I think seems like it's coming up more, especially when I'm talking to agency owners that are like Gen X boomer age, let's say, is aiming for an acquisition. Whenever I dig into like what are you looking to build long
Yeah.
term, it's
Yeah.
more and more of we want to sell this thing in the next 3 to 5 years for
Yeah.
various reasons: retirement, side projects, whatever, employee ownership. So first, I'd love to just say, like, how much is that happening with you?
Well, I'll definitely say the conversations ramping meaningfully. So just like in our portfolio, I am talking to our clients. I mean, if I just look at the 12-month window, compared to the previous 12-month window, like probably 3x the amount of conversations we're having with owners who are saying, I want to start thinking about selling. Or I had somebody approach me to potentially buy my agency. Or I have an LOI. Definitely increased. I'll tell you that the number of transactions, at least in our portfolio, have not grown. So the fervor and you know, the discussions around the idea of selling definitely up. The activities of selling maybe up, but not really.
Yeah.
And I think that's a number of things. Like I do think there's more money and activity, and I do think, like, especially also keep in mind, like you know, our average client is like, let's say 4 to 6 million in revenue, which means their average profit is 800,000 to 1.2 million, right? If they're achieving a 20% margin, which by the way is not the median margin we see, that's the target, but like the median is in our portfolio like 12%, right? So in other words, our median client is doing below $1 million in annual profit. And what I will say is while there are buyers who are potentially interested in, there's not a great market below $1 million. Like it's very fragmented because to be honest with you, like that's not that sellable of an agency. There's a ton of go to zero risk if the agency is generating less than $1 million a year in profit. A significant chunk of its success is just kind of definitionally anchored to the existing owners and partners. So anyway, that's just going to be naturally like a market that is where the buyers are predominantly like individuals that are interested in like entrepreneurship by acquisition. Like that's a very sort of sexy idea now, just like a bunch of, sort of semi-wealthy people who just like want to get in the game and buy a business. And there's a lot of those folks. And then just other agencies who are like, maybe I should buy businesses. Like never really thought about that. Right. So that is really increasing the amount of like cycles. But to be honest with you, these are predominantly non-serious buyers. And for that reason, like they're not completing acquisitions. And so I guess so. That's like the one thing I would just turn as far as like an observation. Yeah, definitely activities going up. And to turn some of that into like advice or just if you're in that situation, you should know that there is a market at all sizes of agencies, but under $1 million in profit, that is a very fragmented, very low probability of success environment. It can be done, but your number one goal should be if you're having that conversation to say, I need to build a sellable agency and start working through like what defines a sellable agency, and size is definitely one of those things. And like I said, sub $1 million in profit is doable, but tough.
Yeah. Let's dig into that a little bit more. From your perspective, what are some of those other building blocks?
Yeah, so I mean, again, the simplest is your size, and beyond the size, like the traditional rule of thumb was 10 million in revenue, 2 million in EBITDA. That kind of unlocks all types of buyers, the holdcos, the PEs, the individuals. Like you've got the most potential, and that's definitely true from what we've seen. Beyond that, like again, you just have to put yourself in the buyer's perspective. Like, what are what else are they going to be looking for? They're going to be looking for an agency that is not exclusively reliant on the founder, They're looking for a business that has that can exist beyond. And so that's like, having a leadership team, but also having a revenue generation source that's not just like this person's relationships. Um, it's, an agency that has at least 50% and ideally like 70% of revenue coming from existing sources and not new business. So said differently, like if you're an agency and 100% of your revenue is just project oriented new revenue, like you do logos and branding for mid-market businesses, and every quarter you just have to go out and sell new work. 100% of your, there's no follow-on work, there's no repeatable work. That is not very sellable, right? Because if you put yourself in the buyer's shoes, what are they even getting? You know what I mean? Like, yeah, you did 3 million last year, but none of that revenue last year is going to convert to revenue this year. And so they're just getting a brand and hopefully an employee who's similarly successful. But what they really are looking for is a client roster that has some repeatable revenue. Does not have to be recurring, just to be clear. There's no reason it can't be an annuity of projects. But it has to be client rosters that have, some degree of repeatability, some degree of retention, and strong margins, right? Like an agency that's generating 50% or so gross margins, 20% EBITDA after paying a reasonable salary for owners. There's a couple others that are maybe a little more nuanced, but those are kind of the big items. Those are just the big items.
Yeah. That makes sense. One thing that I have to talk about every episode is in the frame of controllership. How much is AI filtering down to the P&L with your clients at this point?
So, with regard to like, are we seeing AI trickling down to P&L? The answer is not really yet. If anything, it's cost neutral to additive. And because people are investing in trying different solutions, and it's still an experimentation phase.
Yeah.
So yeah, not a lot of leverage yet. I mean, even in our own business, like we're doing a lot of experimenting. We're trying to create some leverage, and I keep finding that's like I continue to be blown away by what is possible and where I think I'm going to be able to do it, but I continue to hit. Oh gosh, I get 80% of the way there in automating this workflow. But that last 20%, like I can't close it. I'm so close, but I'm just not. And I do think that just is kind of the reality and the challenge presented by AI, right? Like, there's a lot of multifaceted workflows that will be tricky, still doable, but tricky to automate. And so we're not all the way there yet, but in small chunks, I think we're all getting better and smarter. But anyway, I haven't seen a ton of leverage yet. It's coming.
Yeah. I think so too. And I think a lot of it is like going back to what you said at the beginning of this, like if the hardest thing that you clearly need to do is, restructuring or cutting out certain roles because they're not profitable, like AI is not going to solve that problem anyway. Like that sounds
right.
Right.
Yeah, exactly. Yeah, exactly. AI is not going to solve that
maybe you
problem.
could one day, but who knows? So,
Yeah.
Ryan, I guess with that, it's always a pleasure. What are you working
Yeah.
on now, and what's keeping you busy over the next few months?
So yeah, I mean, I think we're a service business just like anybody, right? So like we have the same kind of life cycle, and I think two things for us. One, we have the exciting part. Like I'm a partner in this organization. I've got two other partners, and we're at the point where it's time for us to be doing less client service, and for the next generation of leaders to be taking over some of the things we were doing. And I'll tell you, as a business owner, that's both the most gratifying and terrifying process I've ever gone through. And terrifying, not in my lack of faith in these people. These people are more capable than me by multiples, but really just like, letting go and all the kind of uncertainties that come with it. It's so tough. And finding ways to be productive that don't involve kind of running the operations. And in that regard, AI was a perfect segue, because that's like our number one. Like we just rolled out our big rocks for the year in our all hands like earlier today. And one of our big rocks was all about embracing automation and technology, and yes, in part for creating leverage, but the metric for this rock is one client facing innovation this year. Like, how can we use technology to actually create better insights for the clients that we're servicing? And so that's where 80% of my focus is. Like, all right, it's here. I know we can do something with it. How do we make our clients' lives better? We'll see. I'll report back. I'm
Yeah,
optimistic.
sounds like a plan, man. I'm excited to
Yeah.
see what you guys come up with. And with that, yeah, where can people go to get in touch and follow you and all that?
Upsourcedaccounting.com is our website. We put out a lot of content on YouTube at sign upsourced. Those are the two places.
Cool, man. Yeah, this was always fun, and let's do it again before long.
Absolutely, dude.
Yeah,
For sure, Dan. Thanks for having me, man.
yeah, likewise.